Our next guest was a dollar bull when everyone else was a dollar bear. Daniel Tenengauzer is the head of emerging markets and fixed income strategy over at Bank of America Merrill Lynch, and he joins me now from London. Good morning, Daniel. Thank you for joining us.
Morning.
Now, you had called for a stronger dollar when others were bearish. What were your assumptions at the time, and how have they changed in the last couple of months?
Well, first and foremost, it really is about fair value and imbalances around the world. We believe that some of the larger imbalances, external imbalances in the U.S. have been correcting for actually 3 years now. In the meantime, the imbalances in the Eurozone have clearly persisted. And as a result, we still believe that the euro will be trading below its fair value, so weaker than its fair value going forward. And we really think in the area of 110, 115 is the region where the euro should be going forward.
Now, euro versus dollar has held up a lot better than the euro versus the yen. What does that tell you?
Yeah, well, first of all, it is a euro story. It's not necessarily a dollar story. So that's actually one of the important things. If you look at two very large trading partners with the U.S., the Mexican peso and the Chinese renminbi, we believe those two currencies will continue to strengthen against the dollar. So the dollar, the way we see it, the dollar would be stronger against the euro, but also weaker against China and Mexico. On the yen front, we're somewhat more balanced, mainly because we think that at these levels the yen is somewhat expensive, but we don't see the dollar being extremely imbalanced against the Japanese yen.
Okay, you mentioned weakness in the euro more than strength in the dollar. Talk of a double-dip recession, not only in Europe, but also here in the U.S., kind of growing a bit. What is the market telling us?
Well, the market, first and foremost, it doesn't really agree with the data. I think that overall investors are equally skeptic about activity data from both sides of the Atlantic. So I don't think that the data really reflects what the story is about. Spreads have widened in both Europe and the U.S., so the data is supposed to come weaker in both fronts.
Let's talk a little bit about emerging market opportunities. You say that the fundamentals are superior to developed markets, but how has China's efforts to slow its economy hurt sentiment for these currencies?
Well, yeah, I mean, it's all policy engineered, and this is one very important point that we're trying to make here, is that policy makers have been driving this recovery within the developed as well as the emerging world. We believe that so far this year there's been some pretty aggressive policy making coming from the emerging markets. Only last week we saw India tightening monetary policy and hiking on a surprise hike towards the weekend. We think that the story in emerging markets is about tighter policies, and as a result, activity will slow down. But having said that, this is the region where growth is coming from. So that's where the money will go.
All right. We thank you for your thoughts. We've been speaking with Daniel Tenengauzer of Bank of America Merrill Lynch.